Could you trade by music? Pa, 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 pa. Hello world, good morning, good afternoon, or good evening, wherever you may be around the world. Welcome everyone to Traders of the World, our new interview show where we bring inspiring stories about the financial markets and incredible guests. I'm Professor Flavio Lemos, chairman of the Brazilian local chapter of the CMT Association, and also author of some investment books. And we are speaking English because we want this show to inspire new traders around the world. I hope you like it and subscribe to our channel. Speaking of our guest today, he was previously a managing director of research for Fidelity Investments, where he managed the technical research department, as well as the legendary Fidelity chart room. Also, he was formerly a technical analysis application specialist with Bloomberg in New York and was a regular contributor to Bloomberg Markets magazine. He is also the editor of the book Breakthroughs in Technical Analysis, New Thinking from the World's Top Minds, published in 2007 by Bloomberg Press. Besides being a CMT member, he was the president of the CMT Association, and also he's a classically trained musician and a student pilot. He received degrees in music and psychology from the Ohio State University. So he's known for a lot of things, but he's become a bit of noted expert in the field of behavioral investing. Today, his day job is to educate and empower individual investors and financial advisors to make better decisions using technical analysis. So let's dive in. Here's the chief market strategist at StockCharts.com, where he helps investors minimize behavioral biases through technical analysis. He's a frequent host on StockCharts TV with his show called The Final Buy, and he relates mindfulness techniques to investor decision-making in his blog, The Mindful Investor. Please welcome Mr. Showman, David Keller. Hello, Dave.
Bom dia, my friends, and muito obrigado, Flavio, for that introduction. Very, very kind.
So where do you learn Portuguese?
I've been to Brazil a couple times for work, actually. So I knew enough. I could get it through navigating the streets, getting car service from one place to another, going to Casa de Pau de Queijo and ordering cheese breads. I sort of, getting caipirinhas. I sort of had the most important things covered. So,
so thank you so much for being here. So tell us about your life before Fidelity and Bloomberg. Are you a conductor, maestro? Which instruments do you play? How did you play this move, the transition from being a musician to the markets?
Now, thank you so much for asking about that, Flavio. So I studied music and psychology as an undergraduate, as you mentioned. And, it's funny, I was a working musician through college. That's how I paid for, and basically my fund money was paid for with musical gigs. So I studied trumpet and voice. And so I did a lot of trumpet playing. I played a lot of weddings, did different bands that I could get into, and then sang a lot of vocal jazz groups around Columbus, Ohio. And it was really good, but the income stream of a working musician is super cyclical. So you would have a really good week and then a really bad week. And so it was tough. And so I was ready to take a break from that. So my first job, which was at Bloomberg in New York, I looked for places that would hire a liberal arts major and give me a more steady income stream. And traveled to New York, interviewed, and just really enjoyed the vibe of the place. And then, eventually was taught technical analysis and behavioral finance and everything, real time working with our clients there. Actually, my main focus in college was orchestral conducting. So I actually was training to be a conductor of an orchestra. And I've often told people there's a lot of similarities with analyzing price charts and conducting an orchestra, which seems a little counterintuitive, but it's true. If you know orchestral music, you'll be in front of an orchestra of about 100 musicians, and you glance down at an orchestral score, which is this big, very complicated piece of music. And at a glance, you have to look for patterns, and you have to figure out who has the melody, who's supporting that melody. You have to think about what's coming next based on your knowledge of musical history in that period. And so when I first saw a price chart with a series of technical indicators, it felt like I'd been training to do that for years, because it's all about looking for patterns and recognizing strength and weakness and where there are divergences or where things are moving together. And you have to figure out what might be coming next based on your knowledge of market history and market dynamics. So somehow my degree in music was a pretty good training ground for investing. I've reminded my father, who basically paid for my degree, to remind him that it was a really money well spent to help train me for my career now.
I myself I'm a amateur musician. I play tambourine at this samba school here in Rio de Janeiro, and I play some guitar too. So I know it's lovely to spend all the stress of the market in the musician. So let's talk about the stress now. At Fidelity and Bloomberg, what have you learned to do and not to do there?
Ooh, that's a really broad question. That's good. Yeah, I mean, things that I learned, I would say from my time at Bloomberg, I learned a lot about money management. I sort of had this in my mind. I think when you just learn about investing, you think it's about being right all the time. You think it's about finding that holy grail, what we say, right? That perfect indicator that just allows you to follow it and not have to worry about things. And I started in the industry in June of 2000. So I was introduced to technical analysis basically at the end of the tech bubble, and when things were really starting to get, pretty difficult. Then you had 9/11 and a lot of, the whole bubble bursting during those periods. So I was learning technical analysis at a time when a secular bull market had ended, and we were at the beginning of a secular bear market. And so I learned a lot about money management and how the more important, I guess the more important exercise was how you manage risk versus how you identify new opportunities. And I think technical analysis to this day, I think of technical analysis as more of a risk management tool than an idea generation tool, although it's very good for both of those. But managing risk is so important for investors. And I think with my time at Fidelity, if I could generalize, I got to work with some really successful money managers who had incredible track records. And things that I learned are that they were incredibly patient. So they were not, it's unfortunate that the words trading and investing imply taking action, right? You do something. A lot of times investing should be pretty boring. It's about being more thoughtful and being more deliberate and recognizing how trends are shifting over time and thinking about how you're positioned relative to those. So I learned a lot about being patient and really focusing on the evidence. And so I think a lot of the routines that I use now in terms of how I go through the charts every morning and every week, what sort of tools that I refer to as I'm making a trade really came out of those periods and seeing what worked and what didn't for the clients that I worked with.
So a question that we always ask here in the show for everyone: what are your best and worst trades, and what have you learned from them?
Ooh, that's such a good question. I feel like I have a lot of
work. It wins every time, Nobody tells the bad ones.
I was gonna say, unfortunately for me, I'm a little more humble of an investor. I feel like I have a lot of worst trades. It's hard to pick the worst of the worst, but so best trades for me early in my career, I was a lot more, I think, of a contrarian. So, and I think part of that was because I learned technical analysis as the markets were going lower. So my introduction to investing was really thinking about that 2001, 2002 period. And at that time, it felt for a while like the markets were just never going to go up again. I know, like late 2002, it was just like like the economy is done, like it's over. But recognizing the higher low in March of 2003 and seeing, okay, we've been going down, now we're not going down as much, something's different. And that is where the idea of what I call now a change of character, sort of was born for me. It's like the market had a particular feel, and then it was very, very different, and recognizing that change. So things that I bought around that period were like XM satellite radio, which is now part of Sirius XM, which is, satellite radio was a pretty new technology at the time. I remember buying Royal Caribbean, like a cruise line. And it was things like that it felt like, okay, either these companies are going to go away and we're never going to take cruises again, or at some point we're going to start being more comfortable with it. But recognizing that the charts were showing that idea was starting to work is what really solidified it for me. So when I think about how I relate the fundamental stories with the technicals and when the charts support it, I think was born in that period. So some of the best trades that I still think about were sort of 2002, 2003, recognizing the turn higher and getting into, growth oriented and, travel tourism types of names when that theme seemed completely silly. The worst trade, I mean, it's tough to pick a worst trade, but I particularly remember buying natural gas. And this was probably 2012, 2013. I'll have to look at the chart again, but natural gas prices were steadily going down for years. And I remember looking at the chart, and I still remember looking at the chart on Bloomberg and thinking, this has gone down enough. This is the chart to buy, right? I mean, obviously I should get it because how low could it go? And now I tell people never confuse the bottom of the page with support, because just because the price has gone down a lot doesn't mean it can't go down another 20, 30, 50%. So I bought natural gas and just watched as the chart just kept going lower and lower. And then I didn't really have a good money
negative. We saw,
right.
Being negative. So not even go to zero, below zero.
It can go a lot lower than you think it can, is what I have found. So I think buying because of weakness and having that be your only thesis, I've learned that is a really bad reason to buy anything just because it's gone down a lot. And then I really didn't have a good money management strategy. So when the trade didn't work, I just held on to it and just watched it go lower and lower. And so I feel like most trades I've made after that moment, it's, really listing out why do I think this is a good buy and making sure that I'm using a good technical discipline. And then part of that exercise is always the money management side, right? What's going to tell me that I'm wrong? And even now, when I talk about what I think about the markets or interest rates or crude oil, it's always, here's what I think is going to happen. And if this other thing happens, then I'll know I'm wrong. And then I need to change my opinion. I would encourage people to think with that sort of approach. I think that's going to serve you well.
You said in an interview, a consistent imperfect routine is better than an inconsistent perfect routine. What's your personal trading routine? Do you have a checklist? Could you explain in details how is your trading process?
No, I love that. And I sort of came up with that because I found that people were, really trying to optimize, right? I feel like there are things that are in your control, like how you spend your time, how you make decisions, what information you consume. And we don't spend enough of our time on those issues. We spend way too much time thinking about what the market might do tomorrow, what the Fed might do. And I think you have to remember there are certain things that you can literally change and improve on. And big part of that is your routines, your checklists, how you make decisions. So I would encourage people to focus there if you're looking to upgrade your investment strategies. For me, my decision-making process comes very much from my experience learning to fly airplanes. So when I was just starting to learn to fly, and this was maybe 2010, 2011, I was flying around the Boston area, and my flight instructor, it turns out, was a day trader. When he wasn't teaching people how to fly airplanes, he was day trading stocks. And once he learned what I was doing, we spent most of the time in the air when we weren't taking off and landing and had a lot of work to do. And we're just flying around. We would be talking about the markets, and we quickly found that what you were trying to do in the airplane and what you were trying to do with trading were so similar. And the biggest thing, I think, is the fact that emotions need to be taken out of the process as much as possible. So when you're flying in midair and your engine cuts out, you don't want to have an emotional reaction. You don't want to say, uh-oh, this is something bad. Now what do I do? And your palms start sweating and trying to fix it. You have a checklist, right? You have the engine cutout checklist, and you just go to the checklist, you say, yep, and you just follow these steps. And you learn, after you've done a lot of simulated emergencies, you learn that it's just a thing that you do. When you get this information, you follow these steps. So I think with technical analysis, with any sort of decision making with your portfolio, you need to have that same sort of checklist approach. So I start with the very simple, which is Dow theory. Is this chart going up or going down? And I define that as, are we making higher highs and higher lows, or lower lows and lower highs? And that comes from a number of years working with Ralph Acampora, who I consider one of my key mentors, and he just would pound it in your head. If we're in an uptrend, as long as we keep making higher lows, the trend is fine. If we stop doing that, then something's different. And I feel a lot of times we skip that basic step. Other things that would be in my checklist would be moving averages. Where we're at relative to the moving averages, are they sloping upwards or downwards? Looking at an indicator like RSI to measure price momentum and recognizing if there's excessive strength or weakness relative to what normally happens. And then the last piece on my checklist is relative strength, looking at relative performance, how this stock or ETF is performing relative to others. That last piece is one that, for my time at Fidelity with institutional investors, that is such an important part of your toolkit, because that's how you're paid, right? You're evaluated based on your ability to outperform a benchmark. So you have a laser focus on how well these charts are doing relative to others, because it's such an important way of, a way of demonstrating your value. I feel like with individual investors, they don't pay enough attention to relative strength. And so if anyone watching is not using that component, I think that's key, just to recognize if you're really in something that's helping you outperform. That's an important decision to make.
Okay. Very early on your career at Bloomberg, you wrote a book called Breakthroughs in Technical Analysis, surveying the global landscape of technicians, bringing some light to a lot of different tools. The book is wonderful. I love that book. How was to interview these great analysts, as I'm doing now, as Tom DeMark and Connie Brown? Any good stories you could remember during these interviews? And also, do you still use some of these tools that you survey in the book?
So thank you for saying that book is good. I don't know if I would 100% agree, because I wrote it so early in my career. We started writing that book in 2006. And so now, I mean, that was 17 years ago now. So I feel like if I'd write that same book today, it would be a much better book. So at some point I will get to book number 2, and I promise it will be a vast improvement. So for me, I was sort of starstruck being able to talk to people like Tom DeMark and Robin Griffiths, who's a famous English technician, many others who I'd read about, like Bernie Schaefer. I mean, they had written books that I'd read to learn about options, and now I was able to ask them questions about what they were doing. So I think
that is the gun analyst too.
Yeah, that's right. A lot of fantastic. So I think that those opportunities were a blessing. I would say my conversation with like Tom DeMark, with Connie Brown, with Robin Mesh, who wrote a book or wrote a section on what's called market profile, which is a technique that's used very often in Chicago on the trading floors. It was very popular, looking at market distributions. What struck me about those conversations in particular was these were people that had been doing technical analysis for decades, right? I mean, some of them were sort of at the place I am now, but they were there 20 some years ago. And what was interesting to me is, even though they had done so many good things and had written books and had really built out the technical toolkit for us, they were still innovating. Like, they were still coming up with new ideas. So when I talked with Tom, it was, we have these indicators called sequential and combo, but I'm working on more aggressive versions that I think could be really helpful. Can I write about that? And I remember thinking, how cool is it that someone this far in their career is still trying to improve things and still trying to learn, and recognizing that market conditions are a little different, so you have to adapt the toolkit to do it. I think that was just a really brilliant moment of recognizing that it's a lifelong learning, experience that you have as an investor and as a technical analyst. And the toolkit is always evolving in cool ways, which I think is great. The most challenging part of that book was there was a book on candlestick, or a section on candlestick analysis. And it was Shimizu-san, Yosuke Shimizu, I think was his name, I believe. It was a Japanese technical analyst. And at the time, as far as I know, there were no English books written by Japanese technical analysts talking about candlestick analysis. So we thought it was a really cool idea to get someone in Japan to write about candlesticks and be able to do it. But the problem was we had to translate it. So we had the whole section written in Japanese. We had a translator that put it into English. And what happened was, on one of the edits, as we were going back and forth, they had completely reformatted the article. So headings were in the wrong place. Things that were like bullet points became like column headings and stuff. And so the whole thing had to be redone. So I had to go through with the translator and like restart the whole chapter. So I probably worked more on that chapter than any others, just to get it to come out well. But the experience was awesome. And I feel like, again, after that, being at Fidelity and elsewhere, that experience of learning about a bunch of different technical approaches really built on what I'd done at the CMT exams, of learning about a lot of different technical disciplines. And it was just a great learning experience. So I'd recommend writing a book to anyone. It is a ton of work, though, that I definitely learned as well.
I had written 5 books already. And the last, I have the Portuguese bestseller at Amazon. That's called Tech Analysis of the Financial Markets. So, and in the last book, I interviewed Julius de Campanaro about the RRG. Julius, of course.
Yeah, of course.
And it's a great experience to have this conversation before the writing. You can show the creator experience of in this case the RRG, but Tony Mark has this TD setups and all the indicators, so it's wonderful. Maybe this interview would be a book too. I don't know. I will talk to my editor. Okay. Successful traders are less about home runs and more about streaks. You also are a pilot, so you are probably well disciplined. Do you recommend that investors and traders use risk management? So how to do that? Or how do you do that?
Yeah, no, really good point. And I would say when I taught technical analysis at the college level, I would always remind people it's super important as you lay out a trade. It's here's what I think is going to happen. Here's how I'm going to, sort of represent that thesis with a particular trade. And here's how I'm going to know when I'm wrong, right? Here's what's going to tell me when that call was wrong. So I was looking to see if I have my trading journal. I keep a trading journal by paper. I have a notebook, so it's very old school, but it's worked for me for so long. I don't want to mess with it. But I literally, and I could show you, I write down the trade I'm making, why I make 3 lines. Here's the trade with the levels. Here's why I'm making it. And here's what's going to tell me that this is not the right position. And I stick to that. And what I actually do is I use StockCharts.com, of course, because that's where I'm at as the chief market strategist. So I use that as my primary charting platform. I always put trend lines representing the key levels. And we have a tool called the auto support and resistance. And the line is green if the price is above it, and it's red if the price is below that. And the moment I would have an entry point, I have a chart list of all the open positions. I have one of those lines. And I just randomly once a week or so will flick through all the charts and just make sure, are we in the green for all of these positions? And if I can bump the stop up, I do that. But that exercise and recognizing when stops are triggered and taking action is what's most important. I think it was Ralph, one of my mentors, it might have been Ralph, who said, analyzing the charts is the easy part. Actually doing what the charts tell you is the tough part. And I've learned that is 100% true. So, for me, just having the courage or the discipline to see, okay, the stop was triggered, the trade is made, and don't think about it again. So, early on, I would automate that. So I would set trailing stops and I would do that. So I wouldn't fight the information, right? So if the trigger came, I would sell and I wouldn't worry about it. I've become a little more disciplined. I feel like over time, maybe having kids has made me a little more disciplined, I guess. But now when I see, I do it all manually. When I see the alert, I go right to the trading platform and exit. And I don't really fight that anymore. So I would encourage people to think about it in those 3 steps: the analysis, the entry point, and the exit point, and make sure that all 3 of those are clearly defined, particularly that last one. Because what you don't want to do, I was taught all large losses begin as small losses. So the overall goal should be keep your losses small and admitting when you're wrong. And that's a tough thing for investors to do, but probably the thing that's going to help your performance over time the most.
We are familiar with a lot of biases that are inherent in investing. What is the link between behavioral finance and technical analysis? In your opinion, what are the main biases in investing and how could we avoid them?
Oh, really good question, Flavio. I mean, for me, I think behavioral finance and technical analysis are so closely related. I think of behavioral finance as really an academic discipline to describe how we are wired to make poor decisions. And it's a lot of things that we are designed to do as humans that are in some ways very good features if we're trying to survive in the wilderness and find food and avoid danger. But for investing, a lot of times that fight or flight mechanism can get us into a lot of trouble. So I think technical analysis adds rigor and adds discipline, and it gives you structure so that you're not reacting based on your emotional reactions. You're reacting based on the weight of the evidence. So technical analysis for me is, I think, the primary way that you minimize the impact of behavioral biases. And there are, literally hundreds that people have classified. I think the 2 that would come to mind would be confirmation bias and endowment bias would probably be the 2 I would identify. Confirmation bias people are usually pretty familiar with, and that is, a logical approach to making a decision would be you'd gather evidence and then make your decision, right? I want to decide whether to buy this car, so I gather a bunch of evidence about the car and about the features and all the information, and then I decide whether or not I want to buy the car based on that and the price and all of that. But if you think about what a car salesman does is the first thing they do. They don't give you a bunch of information about the car. They want you to get in the car and drive it around, because then all of a sudden you're thinking about yourself in the car and you're envisioning yourself as this cool person with this great new car. And so as a result, you make the decision first, and then they give you information to help you feel better about making the car. So they want you to decide first and then back it up with information. So we do that with investing as well. We decide we're bullish on stocks or we're bearish on Bitcoin. And then we just kind of gather information, not to make a better decision, but just to make ourselves feel better about that decision we're already making. And so unfortunately, what happens there is you're usually not open to new information, particularly when the picture changes. You're not as prepared to recognize that the information is different. So what you really want to focus on is have a good routine of gathering evidence. So for me, I call it a morning coffee routine. Every morning, I look at the same set of charts. It's about 100 charts. I go through it every morning with a cup of coffee. And by doing that, at the end of that process, then I start answering the questions. Where do I think the S&P is headed? What are the key levels I want to pay attention to? What about bonds and cryptocurrencies and all these other things? But it's not based on a gut feeling. It's based on the evidence that I'm gathering. So that's an important thing to remember. Endowment bias is where you honestly tend to hold on to things too long because of your emotional attachment to those things. And with a stock, let's say you own a stock like Vale or something like that, right? And it's been a really good name. It's been good in your portfolio, but then the chart starts to turn lower. And all of a sudden it goes from being a strong chart to a weak chart. Endowment bias causes you to keep holding that stock, even though the evidence has now completely changed, because of your emotional attachment to that position, not because that the evidence has changed. So with both of those biases, having a good, consistent process of analyzing the charts, having key levels in mind so that you can have an indication of when an uptrend becomes a downtrend or vice versa, is what helps you minimize the impact of those biases. So I think it always comes back to a consistent routine of analyzing charts is going to serve you pretty well.
And you have all the noise in media, shouting you every day, every minute about, oh, we're gonna die, we're gonna low, wherever. The interest rates will go to 15, and so everyone becomes very nervous. So I myself, I avoid the news because they are too messy.
No, I agree. And what's funny, Flavio, is that a lot of news by design, right? They want you to watch what they're doing. And so it tends to have a very short-term focus, whether or not they, mean to do that or not. Every small little number that probably isn't that big of a deal, they make it seem like it's a really important deal. So I think I don't watch a lot of financial media either. And I like to focus more on long-term trends first, because that helps you recognize the overall trends. The short-term movements a lot of times can just be noise, and you want to make short-term decisions using short-term data, long-term decisions using long-term data.
The night is darker before dawn. Huh? So if you watch the media, you never buy on a support.
That's exactly right.
So which specifically technical tools you use? Also, could you show some your vision about the markets now? So bring your shots if you want.
Yeah, I'll share my screen. Is that okay? There we go. Can you see my screen all right?
Yeah.
Perfect. So, for me, I'll start with just looking at an individual stock. I mean, my general approach to charting is super simple. And I think that comes from most of my career was spent not with, technical analysis aficionados, not with technical analysts. I spend most of my time working with people who did not use technical analysis. So I was working with fundamentally oriented portfolio managers or, brokers or, FX traders that had an awareness of charts, but they didn't really use it as a primary tool. So I was always trying to use things that I could easily explain that I thought would be consistently helpful, particularly for equity and ETF investors. So I settled in on a series of indicators, and this is pretty much what 90% of the charts that I look at probably look very similar to this one. This is Home Depot, which is a US-based home improvement company. If you're not familiar, and so I basically look at a 2-year daily chart. I have the 50 and 200-day moving averages. I have RSI. And then relative strength, looking at Home Depot versus a benchmark. So for me, usually I'm doing the SPY as a main US benchmark. And so for me, I literally start at the top and just go down to the bottom. And so things that I would do looking at a chart of Home Depot, first off, where are we at relative to where we've been? And I find a lot of newer technical analysts or newer traders kind of read it like you would read in English or read in a lot of Romance languages, where you start on the left and kind of go to the right. And I encourage people, you want to start at the right, start at the current day, and then look to the left, right? So look at where we're at relative to where we've been. And one of the reasons why my show on StockCharts TV is called The Final Bar is because I would say that a bunch of times. I would say, all right, start with the final bar and then look to the left and see where we've been. And also there's a musical connotation to the final bar too. That was the other reason why we went with that name. So basically with a chart like Home Depot, it's recognizing that we're right around $300 a share. We're below resistance around 335, which is actually a well-established resistance level. We're above support around 275, 280. And so seeing where we're at relative to those key levels can be really, really helpful. Home Depot is one of those charts. I feel like a lot of charts now are sort of in a range-bound type of environment. So recognizing where we're at relative to those extremes, thinking about what levels may be of importance are pretty helpful for me. Then I will look at where we're at relative to moving averages. So we just broke down through the 200-day moving average, which is not a great sign. I was taught that nothing good happens below the 200-day moving average, which is kind of an oversimplification, but overall tends to be a pretty good way of doing things. So in general, if you buy things and you own things that are above the 200-day moving average and avoid things that are below their 200-day, you're probably going to do pretty well over time. We also broke down through the 50-day moving average, and a lot of U.S. stocks, a lot of global stocks have had that pattern in the last couple months. And I think, when I think of the evidence that suggested the bullish phase into June, July has now rotated lower, so many stocks breaking their 50-day moving average like Home Depot and many others, I think was one of the more impressive signs of what I call a change of character. Then I look at price momentum, and what I have to recognize on a stock like Home Depot is we've become oversold. And while that on its own doesn't mean we're going to go back up, it does mean we've gone down quite a bit relative to the normal volatility of the stock. So recognizing maybe a short-term bounce here is kind of important within the context of the longer-term analysis. And then relative strength, the relative performance is vital to me. So I'm always, in general, one to own things that are going where the relative strength line is improving, and not owning things when the relative strength line is going down. And the way that I would encourage people to think about that, I don't know if you guys follow baseball or others do, or in the US, we're kind of getting to playoffs, so it's pretty heated. My Seattle Mariners are kind of getting to the playoffs, so it's pretty important. And with baseball, you think about if you're the manager of a baseball team or a football team, a soccer team, or whatever sport, are you going to put your top performers on the field? If you are the captain of Brazil, or if you're managing Brazil's national team, are you going to put your top performers, right? The Neymars, the top, of the game, or are you going to put the ones that are struggling, that are having a difficulty and going through a tough stretch? You're obviously going to put your top performers because that gives you the best opportunity to beat another elite team. So why would you do anything different with your portfolio? So in general, owning stocks where the relative strength is going up means you are putting your top performers out on the field. And if you're a medium-term, long-term investor, if you're looking a month out or more, that basically tells you that trend following is a really good approach, what's called momentum investing, buying strength and underweighting weakness. And so that indicator at the bottom is one of those tools that helps me to make sure that I'm owning the stronger performers and allocating things that way. Does that make sense?
Yeah. And now energy is the number one leading sector.
So and I was going to say, in terms of my general market view, I'll tell you in terms of rotation, you mentioned Julius DeKempener. I've known Julius for a number of years, and we often talk about sector rotation. It's been pretty clear what the rotation has been in 2023. The first half of 2023, all about the growth sectors, technology, communication services, consumer discretionary, and it was the mega cap FANG stocks, as we would call them, that have done so well, right? Meta, Amazon, Apple, and so forth. All of those charts have now rotated lower, right? And it started with Apple and Microsoft kind of gapping lower here not too long ago in early August. Around Labor Day here in the US in early September, many of them put in a lower high. And charts that actually were holding up very well, like Alphabet, have now pulled back as well, now testing their 50-day moving average. So the ones that have been holding up in an uptrend as long as possible are now testing support as well. So what's actually working, as you implied, Flavio, I think energy is certainly clearly one of the stronger places. That's driven by higher oil prices, and I don't see anything on the chart of crude oil telling me that that uptrend is over yet. It could be tomorrow, but as of today, I'm not seeing anything. So I'm inclined to follow those trends higher. What you have to remember from a fundamental perspective or a macro perspective, higher crude oil prices tend to imply higher inflation, tends to have a negative impact on consumers. So a lot of the consumer-driven, service-driven stocks that have been leadership for so long, it's not a great environment for that. I would say the other big thing I would focus on at this point would be interest rates. So sorry to jump around a lot, but this is the chart of the 10-year yield. And interest rates are going higher. And a big part of that, of course, is the Federal Reserve raising rates. They've implied additional rate hikes through year end. But the long end of the curve, which is what we're looking at here, this is the 10-year point, has been going up as well. And that's really more driven by free market forces. So when interest rates go up to this degree, it is a major headwind to growth stocks. So our benchmarks in the US are very growth heavy. They're very growth oriented. It's all about technology, communication, telecommunications, consumer names, service names, internet names. And all of those stocks that I just mentioned, their earnings growth has greater value when rates are lower. When rates are higher, it's just much more difficult for those stocks to do well. So areas of the market that I'm looking for opportunities are energy, industrials, materials. Energy has started to do very well. Things like materials and industrials still really haven't emerged yet, but as long as rates remain elevated, I think that's probably where the opportunities are going to be. And the charts are starting to improve to that degree as well.
I don't see any volume. Don't you use any volume as a timing tool?
Yeah, you'd mentioned volume before, and I really don't a whole lot. I do use it on a limited basis. And what's funny is when I was learning technical analysis, 2000, 2001, I was taught volume was incredibly important. And I remember looking at like Barini money flow, Laszlo Barini's money flow indicator, and a lot of other tools like that. But I have found that, or earlier on when a lot of the literature was written on technical analysis in like the 60s, 70s, 80s, volume had a certain implication, right? If a stock moved on heavy volume, that would imply institutions making moves in their portfolios. And I think to a degree that's still the case. But the market structure has changed very differently, right? So in 2023, you have dark pools and high frequency trading and hedge fund activity, a lot of hedging that's happening, and all of those can influence the composite volume reading. So when I do use volume, I used indicators derived from volume. So like Joe Granville's on balance volume, I'll use. Other ones I like Mark Chaikin's indicator, like the Chaikin money flow and accumulation distribution. I think those are good representations of the trend in volume over time, as opposed to just the daily volume reading. So I don't use volume as much as just a pure analysis of price, but I use the Mark Chaikin indicators more than anything.
Okay. Could you suggest some good books? Eddie?
Yeah, really good question. So some technical analysis books that I would say, I mean, the one that would come to mind would be William O'Neill's How to Make Money in Stocks. And it's really not a technical analysis book. That's really more about holistic investing. It deals with what I would call fusion investing, which is the relationship of, fundamental analysis and technical analysis, buying good companies that are also good stocks. And I think William O'Neill, better than anyone, probably explains that relationship and focuses on why good companies that are actually showing good price behavior and good relative strength is so important. So a lot of my methodology of picking stocks came from my time at Fidelity, and that was a very William O'Neill kind of approach. So if you want to know how big money managers use technical analysis, I think that's a really good book to do it. Another one I would say, because we talk about behavioral finance, James Montier's book, Behavioral Investing, is really well done. That talks a lot in more detail about behavioral biases, just how you think about investing, what happens between your ears, and why that's so important. And then as a non-technical analysis book, just because you kept it open-ended, I would say Free to Focus by Michael Hyatt is a personal productivity book. This talks a lot about how you spend your time. And I know when I think about my investment process now, I used to waste a lot of time. I feel like looking at things that were not particularly helpful, distractions and things like that. Books like that and Stephen Covey's books about how to manage your time and your priorities have been transformational in helping me to think about how I prioritize. So I have a planner now that is built on those books that I just mentioned. It's here in front of me, and that's how I'm prepared for this interview. And the next thing I'm going to do too is by having a good discipline with my time. So those are 3 books that I'd suggest.
That's great, Dave. Where the audience could follow your work on social media, please do some ad.
No, I appreciate it so much. And guys, it's such a pleasure to see you. I've really enjoyed. I enjoyed your discussion with John Bollinger so much. And John and his daughter Zoe. It was really fun to watch. I'm honored that you would invite me as well. It's a pleasure, guys. For me on X or on Twitter at Keller CMT. So I'm usually sharing a mix of charts and then inspirational quotes about the markets. I think a lot of what we do as technical analysts is teach people market history. And I find if you want to know what happens in a period of high inflation and rising interest rates, the good news is that's happened before. Just go back in history and you can find other periods to read about. So charts are a really good way to learn those lessons. And then on StockCharts.com, that's where I post a lot of my content. And I host the daily Closing Bell show on StockCharts TV. Just go to our YouTube channel. You can see it there.
John always tell us to read all the classics, and it's awesome advice. So, David, what's your final advice to younger traders?
Ooh, that's such a good question. I think for new traders, we mentioned earlier about taking action, right? And I think again, it's unfortunate that in English the word trading implies that you're actually doing something. What you have to remember is a successful trader. I remember spending time with Steve Cohen at SAC Capital and standing there on the floor and watching him trade. He wasn't just trading all the time. A lot of the time he was just looking and he was observing and he was waiting because he was looking for a good opportunity. And I think new traders, particularly early on, you try to trade your way out of a period of bad performance, right? It feels like when you're having a bad run, you feel like if you trade more, you can kind of make it better. And it's just like a gambler doubling down when it's just not a good time. So what you have to remember, Jesse Livermore's famous quote, there's a time to go long, a time to go short, and time to go fishing. And I think recently, certainly in the US equity markets, it's one of those times to just sit on your hands and wait. If there's not clear evidence, if there's not a clear opportunity, if you're not getting a buy signal or a sell signal today, wait for it. Don't force it and don't anticipate it just to try to get an edge. Focus on your discipline, have a good approach, and stick with it. That's what's going to help you more than anything.
Thank you very much, Dave. So to end with a grand finale, could you play something for us?
Happy to do it, Flavio. Happy to do it.
Oh, that's awesome. And we come to the end of this amazing interview with David Keller. We want to thank you all of your viewers for joining us on this journey today. Dave, this has been an honor and a pleasure. We also want to say thank you very much for sharing all these thoughts and insights.
Muito obrigado, my friends. Thanks so much.
Thank you, everyone. We'll see you in the next interview.